welcome back to the show. Today's episode is one I think a lot of people are going to find fascinating, especially if you're ever looked at your bank account, your savings rate, or the broader financial system and thought, there's a better way to go. Our guest today, Austin Fowler from Stairway Invest, a platform built around a bold idea. What if you could get the kind of yield people typically associate with more sophisticated investing, while still maintaining short-term access to your capital? Stairway says it offers 8% return with 7 days liquidity. And naturally, that raises some big questions. How is that possible? What's happening behind the scenes? How is risk managed? And how does this compare with what traditional banks do with your money every day? Austin is going to walk us through this model, the thinking behind it, and how the company approaches investor education, liquidity, transparency, and why he believes this is part of a larger shift in how people will think about money and investing over the next decade. Austin, welcome to the podcast.
Thanks, Anthony, for having me.
Well, let's start with the big picture. The headline, banking without banks, is a bold phrase. And when people hear 8% with 7 days liquidity, the first reaction is usually skepticism. So in the simple terms, what is Stairway Invest and how does it work?
Absolutely. So our goal is to connect people with professional investors. A professional investor can easily beat an 8% return. And if you really think about it, everyone knows this. Even if you put money in the S&P 500 and leave it there for long enough, you're going to beat an 8% return. If you have control of deals, particularly in real estate, where you can control your entry price, what you do to the asset, force the growth of the equity, there are many ways to do a lot better than 8%. So the question when I built Stairway was, well, how do we connect people that can do that, professional investors, with people that wish to get a great return and still keep liquidity and have an asset-backed secure account? And that is where we started. Banking itself doesn't let you do this. So if you go and get a banking charter, you are not able to access commercial real estate investment. You can't take deposits and do that. So you have to step outside that. But the Regulation D framework, you can. You can connect a professional investor that knows how to beat 8% with someone that wants a liquid account that pays 8%. And now the depositor can get education from the professional investor and both can create a win-win scenario. So we have managers that invest in a diverse range of assets. Everything from cash, stocks, single-family long-term rentals, short-term rentals, multifamily, value-add, ground-up development, solar panels, fractional ownership of single-family. There's a diverse range of options out there. Flips, we have a manager that specializes on flipping houses. All of these things have the capacity to generate strong returns well in excess of 8, giving you a business foundation to offer an account that pays 8. The only question then becomes, well, that makes sense. There are many funds, real estate investment trusts out there that have returns above 8. But how then do you achieve liquidity? And again, anyone that's thought about finance for a little bit knows that this is always possible. If you wish to redeem shares in Amazon, one of the largest companies in the world, you don't trigger a sale of Amazon, the company. It is a match with someone that wishes to exit that business. And that can be done with anything. Create a secondary market for any asset, liquid or otherwise, that matches people that want to get into a fund, which matches people with people that want to get out of a fund. So liquidity is always possible to create. If you wish to do even better than that, then you simply do what banks do and you keep a substantial fractional reserve, which means you don't just match people wanting to get in and out, but you also have cash on hand to immediately redeem people. And over the course of a month, as money flows in and out of any institution, deposits and withdrawals tend to balance out. And Stairway at its current scale with approximately 700 clients realizes that vision. Cash reserve, illiquid assets, both demand and supply of people moving one in and out, and it all balances out. So it's not so complicated. We even teach people how to do this themselves, how to build their own managed fund this way. So we offer a full education program from you know nothing, great. Get an account that pays 8%, couple you with a professional investor that knows how to beat that. Learn. When you're investing and beating an 8% return, if you wish, learn how to run a managed fund. We take people that whole journey all the way up to working with large-scale operators that manage hundreds of millions, sometimes billions of dollars of assets. So that's the ecosystem, really breaking down all those barriers that tell people, well, I can't learn how to professionally invest. Yes, you can. We'll teach you, not just for free, but we'll pay you while you're learning. No, I couldn't possibly run a managed fund. Well, we'll teach you how to do that because we'll show you how to set it up for a few $100. Manage a small amount of money, invest at the small scale and learn how it's done without taking risk or building some enormous structure that you would never do. Make it simple. And if you like it, we'll show you how to make it big. The goal is really to invite everyone, all walks of life, whatever your job may be, whatever your background may be, and show you every step of the way from where you are to as far as you could want to go, and make it simple, give you support. We have a vibrant community of over 850 investors. Any question you can ask, there are people that can help you answer it. Plug into it, learn, participate. It's all there. And, we don't tell people things that are not true. It's not true that you can to invest in a week. You can't. You can't pay someone tens of thousands of dollars and learn everything in a week. It doesn't work that way. A lot of the journey is psychological. You've got to get comfortable doing things you're not comfortable doing. And that can take years. I'm not going to tell you it's going to take years. It can. But we take that time, expose people to deal after deal, see real money going to real deals time and time up again, until people can understand that, yes, there are people out there that know how to invest professionally, which for some people is already a revelation. They don't understand that it is actually possible to be good at investing. There are people that are very good at it with great track records, and you can be that person too. You just need to learn from them.
So in your view, this isn't magic. It's really a transparent spread business.
That's right. Too few people openly talk about what they do, but that's our culture. If someone comes to me and asks me a question about my finances, no matter how detailed, I'll answer it. They want proof, want backup documents, I'll give them. Because that's how we teach people. We don't want there to be any wall between the person that wishes to learn and the data behind the person that's actually doing it. Total transparency. It's how we build credibility. It's how we keep people safe. It's how people can see the assets that generate the return on their accounts and copy that and do it too. And in so doing, if they are copying us, because we want them to, they can keep one day their clients safe. We don't advocate for the philosophy of go out and invest on your own, because if you do that, there is no way you could possibly do due diligence at a professional level. You can't do it on your own. With 850 people, when we do due diligence on a deal, 150 people are participating in that. Now, of course, there'll be some that just lurk and read on the sites, and that's fine. People can learn. We have many professional investors that ask questions that normally as an individual you would never ask. And normally as an operator, you would not answer anywhere near as many questions as we can answer, because we're a group of 850 and the operator knows every single answer they're giving is going to 850 people. So if you have a look at the due diligence we do on a deal, you'll sit there and go, well, that's incredible. How on earth did you get that much detail from the operator? And the answer is because the operator was building their credibility with 850 people. They were enjoying the process as well. So never invest alone. It's not a safe way to do it. Invest as a group. Way better due diligence. 1. 2. You get better deals. The operators enjoy the experience. They'll bring better deals to the forum. And 3, you can create liquidity in otherwise illiquid assets. If you have a life event and need to exit that deal, if you had done it on your own, you're stuck. As a group, someone else can buy you out. And this is a process we do quite often on the forum. You'll find deals where we are explicitly buying out another investor from what is traditionally thought of as an illiquid deal. We have a deal that we're doing that right now on the forum. So many people don't realize that liquidity can be engineered. Just don't be alone. Don't be a solo investor. Join a group and do it right. Do it professionally.
Well, let's unpack the economics a little more. You said the fund is borrowing at 8% and then deploying that capital into equity opportunities targeting stronger returns. Give us an example of some of these opportunities that you're investing in.
Sure. So one of the core things that we invest in, and as mentioned, we invest in many different things, but let's keep it simple and focus on a core one, is commercial real estate in all of its varieties. Building affordable housing ground up, value add, both deep and light. There are many, many different ways you can do it. Commercial real estate traditionally raises capital at approximately 20% per annum. It varies between operator, but approximately. A normal deal will hit numbers on average around ballpark, approximately double your money in 4 years. For many people, they're not even aware this industry exists. And if they are aware this industry exists, many people never invest in it, because when you do invest it, typically you need to be accredited. The minimum investments can often be $50,000, $100,000. And not just that, when you are even thinking about getting into one of these investments, the first thing you'll get is a 30, 40, 50 page offering memorandum and a 100, 150 page private placement memorandum, and they're pretty intimidating to work through. Many people just will stop there and say, no, that looks too hard. But nevertheless, if you can overcome the hesitation to even participate in that industry, very strong returns are available. And you can find operators that have track records of decades where their average return is around 20% per annum. Not every return, not every deal goes well, but average is around 20. Some operators even higher. So that is our general target, to get a great risk-adjusted reward. And how can that be done? It is not rocket science. An example of a good deal is you build a piece of affordable housing, which is something the market needs, in a suburb that is bustling, great opportunities for employment, education, entertainment, and has very little land left. Ideally, you're building the last building that can fit in that suburb. Then, if you work with a developer that has a great track record of controlling their build costs, you can build a product below market price. And this gives you a great space to have a day one built-in equity in your deal and great upside. One of the operators we work with, Urban Genesis, would like to call them out. They're very good at what they do. They work in Texas, they work with the governments, they get a property tax exemption in Texas, where property tax is huge, for 99 years to forever, which means they can offer an apartment at a rent lower than their competition and still, as a deal, generate more income. And it gives them many ways to make their deals safe. So let's really dig into what that means. During COVID, Urban Genesis had a deal which they completed. They built the building, but because of supply chain issues, they could not get a transformer to electrify the building. No one could move in. And it sat on construction finance for a year, 100% vacancy. You imagine what would happen to most operators if that happened. It would be a disaster. And yet, they got their transformer, they tenanted out the building, they sold it, and their investors still did not lose principal. They didn't make very much, low single digits, but that's remarkable given market pressure of that kind. Why is that possible? Because they're a great developer that can build below market, they have a 100% property tax abatement, and these two things keep you very safe, even in an extreme downside event like that. It is possible to choose deals with a very high potential for reward that are safe, because the high reward gives you many ways the deal can go wrong and still not lose your money. It is not true that high reward always equals high risk. Sometimes, for example, if you manage to buy a building at 50% off, high reward equals low risk. Again, because many things can go wrong. To give another example, we invest with a fund that converts hotels to affordable housing. A tired hotel in a market where Airbnbs have taken over, they're just not doing very well, can sell at 50% its replacement cost. The owner doesn't want the asset anymore. And if you as a fund buy that asset and then convert it to something the market does want, affordable housing, Sage Investment, another great group to call out, that's what they do. They can buy an asset at a low multiple of income, turn it into something the market wants, affordable housing, and then sell it at a high multiple of income. And again, they target very high returns, a fund that targets 20% and higher returns per annum, where the high return does not indicate high risk. It indicates a great market opportunity, a thing that needs to be done, a market fit. And so these are examples of the deals we look for. Our goal as a business is to teach people how to borrow at 8 and invest at 20.
So you're not just betting on asset classes. You're betting on operators who know how to navigate cycles.
Absolutely. So we start with the operator, right? Not just the deal. We want to work with operators that in general have order a minimum a decade of experience and at least 10 buildings they've taken full cycle. We want to see their track record with investors. Even better, having navigated the recent market upheavals with interest rate swings well. Many operators did not. Work with the ones that did. So it starts there. Good due diligence on the operator. And then, as mentioned, use the forum, 850 plus investors, to do great due diligence on the deal. And last but not least, very importantly, market timing. Market timing really, really matters a very great deal. When I was looking during the 2020-2022 low interest rate window, we were not looking to get into multifamily. The valuations were crazy high. There were people buying assets that they felt would cash flow strongly because of the wonderful cheap debt they had got. And in my mind, I'm just looking at people doing, this is a ticking time bomb. The rates are not going to stay low forever. Once they go up, you have bought an asset whose value is inverse to the interest rate. Your values can only go down. So we instead focused on single family, where we could lock in 30-year fixed debt all the way to paid off and get great cash flow that way. In commercial real estate, for those that haven't been in it, you typically don't get 30-year fixed debt. 5 years is more normal, maybe 7, maybe 10 if you're lucky. But it's not usually 30 years all the way to pay off. You are going to have to refinance sometime around this year or the next few years. And that has created a lot of pressure on a lot of operators that bought deals that really didn't make sense at higher interest rates. It pulled down the value of the building, it reduced the free income of the building. So we did not get into multifamily at those rates. I waited until September 2023 when the interest rates peaked, when the Federal Reserve stopped talking about rate rises and started talking about rate cuts. It's not as though it's incredibly difficult to time that. The Federal Reserve tells you what they're going to do. Only then do we start looking at multifamily, because when the rates have peaked, that's when there's maximum pain on the multifamily industry, the best times to enter. You want to get into multifamily when the rates are likely to be stable to slightly dropping over the next 3 to 5 years, at a time when you have a reasonable belief that over the next 3 to 5 years that statement will be true. If there's great uncertainty or a chance that things are going to spike up, you find other asset classes like renewable energy. If interest rates are low and you can buy a lot of durable assets at a low interest rate cost and generate high income, that's a great sector to get into. So market timing, asset sector choice matters. You don't want to be a one-size-fits-all investment strategy year in, year out, because some years are different to others. Some assets don't make sense in some years. So teaching people that flexibility and building that diversity into their acquisition is really, really important. There's no one tech you can learn that is great for every market and every time in history.
Well, this 800 people community that you've built sounds very interesting. Kind of explain how this works in real practice.
Sure. So it is a simple Google group. Anyone with a link can come and join. There are no fees for anything. In the entire ecosystem, there are no fees for anything, because that's the way we like it. I don't like fees. Why would I build an ecosystem that has them? Once you join, you can see deals posted. Usually we keep the deal flow low, no more than about a half a dozen deals a year. Why? Because if you buy a half a dozen deals that have a duration of order 3 to 5 years, after a 3 to 5 year cycle, you're going to have a couple of dozen deals on your books. That's plenty come tax time. You do not need 10 deals a week or a month or even 1 deal a month. It's too many. Quality, not quantity. To quote Warren Buffett, one of the biggest problems of many people when it comes to investing is poorly researched diversification. All right? Just because you choose many assets doesn't mean that is a good portfolio. As mentioned, even at a half a dozen deals after the cycle, you're going to have enough assets. Better choose them really, really carefully. So a deal will come on to the forum that I've done thorough research on, and then the questions begin from people. What about this? What about that? And the strong advice to everyone is you don't invest in deals that don't pass the gauntlet of all the questions of hundreds of people, because it's risky. You want to make sure that you find all the details that are wrong. We've found deals where a building was listed as 96% occupied when it was actually 96% vacant. All right? Just a typo. The clerk had just written the wrong number. But you only uncover these things when you have enough bandwidth in your group to say, hey, could you go and check out the comparables? Just literally call them and just ask how the building's going. And they found that the building was actually barely starting to lease up, not almost complete. You find issues in the financial models. These are complicated documents, big spreadsheets with lots and lots of formulas. And we've found ones that are just wrong. They're just predicting the wrong thing. They have no connection to the reality. With our group, we have the people with the technical expertise to uncover that, and so on, right? Any issues with the legal lockup, we can get these negotiated before people commit to the deal because we have the bandwidth. You could never do it on your own. So come and join, basically, and read and participate. Also, it's the attitude that is compatible with the real world. I am never going to buy a multifamily apartment building and walk all of its 100 doors to make sure that they're all good before purchase. I am not going to do that. That is not part of my vision of financial freedom. Same with most people. Most people are not looking to be the hands-on asset manager that has to get their property managers in hazmat suits in the middle of COVID because there's a disaster going on. They don't want to be dealing with the day-to-day extreme events that can and do occur in real life. You want to be a passive investor. That's what financial freedom is to me. That's what financial freedom is to most people. And most people are busy. They have a career, they have a family, they have hobbies. And so we must teach investing in a way that is compatible with very limited time availability, both now and in the future. That's the goal. We don't teach people to go out and tear out drywall with their bare hands and spend 100 hours a week working. Not interested. I'm not interested in that. Most people are not. We teach people what it means to invest as a passive investor. Share the load. So you join the group. The due diligence is done mostly not by you. Maybe you'll contribute a half a dozen questions to the hundreds of questions that get asked. And that's enough. Because collectively, that leads to a great result for everyone. Low work per person, great deals, efficient, not excessive deal flow, high quality assets. You acquire them, and then a couple of months later, you'll consider whether you get into the next one.
So what you're creating is a network intelligence layer on top of a traditional deal review.
Absolutely. Absolutely.
It sounds like the transparency really helps build trust faster.
Yeah. And education. So the trust that the deal is good and the confidence that you now understand the deal. The terminology can be foreign when you're new to this area. We'll explain it. The financial models may be unclear. How do you justify those assumptions? We'll explain it. All of the details that you sit there and if you're on your own, you go, well, don't know, don't have time. We'll explain it. Lay it all out, make it simple. And there's nothing better than having the leverage of people that have experience investing in these assets on your team, helping you with due diligence. They invest alongside you. Everyone has a shared interest to do well.
Let's get into the bigger question people are always going to have, the question of liquidity. You offer a 7-day redemption term. How do you support that while investing in assets that are often longer term?
Yeah, first we start with cash reserves. So we always keep millions of dollars of cash on hand. And I've been doing this since 2002. You keep a sufficiently large cash reserve, and then your monthly needs as money flows in and out are satisfied. Our cash reserve has, in all situations, including the global financial crisis, including COVID, always been sufficient. We don't stop there because that's not how you build a secure business. We also have substantial liquid assets, stocks. And you don't stop there. We also then have funds that are semi-liquid, maybe with a week or two, could be liquidated. And then so on. There's no such thing as an asset that cannot be liquid. We mentioned multifamily, which typically people associate with multi-year lockups. Our forum has a history of buying other investors out of such deals. You can make even those liquid. So we have a rolling cascade of liquidity, starting with cash, moving on to stocks, moving on to funds, moving on to other deals that people traditionally think are not liquid, where even if there was an enormous number of people that wished to exit, and as mentioned, I have over 700 clients, in practice things balance out. But if, for whatever reason that happened, there is a clear procedure where you would systematically liquidate things and satisfy withdrawals. In practice, withdrawals are initiated same day, and people have their money back the next business day. That's normal. Indeed, if a client is on a bike going down a street and sees an auction and participates and has bought a house that same day and needs money wired to escrow immediately, we will do so. So you can get same-day liquidity. Now that's at request. We don't do that all the time, but if someone is in need of taking opportunity same day, we'll make that happen. It's all about having a great return on your idle capital without locking it up so you can't take advantage of better opportunities when they arise. And we ourselves will post better opportunities on the forum all the time. Better by return, but yes, less liquid. Everyone has two pots of capital. The money they need to keep liquid for day-to-day things. And the money they don't need for today, they can afford to lock it up for 3, 7, 10 years. The liquid capital, we teach people, keep it in an account that pays 8. It's a lot better than you get from a bank. The illiquid capital, we teach people to target around the 20% level and show people exactly how that's achieved. And then if you wish, we'll show you all the way up to how do you raise capital at 8 and invest at 20. It's not for everyone. Some people just don't want to do that. But if you do, we'll show you how.
And you created an interesting product after reviewing and talking to you earlier. You've also built in your own penalty if redemption is delayed past the normal window. Is that correct?
Precisely. To be clear, this has never been triggered since 2002, so nearly a quarter of a century of operation. Legally, actually, if for some reason we did not, with all of the infrastructure I just mentioned, satisfy a withdrawal within 7 days, the account would switch to 25% per annum. So this is a kick in the butt to make sure that we don't do that. If we did, there would be an apology to the client in the form of a lot of extra interest. To really set a tick and say, no, you make this work, right? You sell the asset you need to do, you get the liquidity you need, and you make it work. But as I said, we've never needed to trigger that clause. Under all circumstances, withdrawals are triggered the same day with next day using an ACH receipt from the client. But yes, we make sure that the contract is there to enforce that behavior from every manager.
So people hear yield plus liquidity. The next question, of course, is going to be risk. What are the core risk controls that give investors confidence in this platform?
It starts with the managers. So we only onboard managers that are professional investors. So people that have a substantial portfolio, typically multi-millionaires. People that have a track record. We like people that have unique angles. So whenever we can onboard a manager that has a unique way of investing, unique ways of investing are great. Typically, some of the best returns are when you have a unique angle. I mentioned the hotel to affordable housing conversion. That's a unique fund. It has a great way of operating, great market fit, gives them great returns. People that have unique products in there's a thing called a pad split, where you turn a single family home into a place where 6, 7, 8 groups of people, usually individuals and couples, can live. It's a unique way of approaching the market. Very strong returns, high cash flow. So wherever we can find managers that have interesting things to teach, that's where we'll focus. So that's where it starts. Great professionals that manage money. Secondly, those managers have to bring their worldwide assets to the table. Client capital is not just backed with the assets bought with client capital. It's backed by all of the assets the manager has built up over a lifetime as well. So we have very deep equity buffers from all of the managers to make sure that even in a very, very bad year or a very bad set of deals, there's still plenty of equity left, plenty of assets left to ensure that even if everyone withdrew all their money, those assets could be sold and every single client would be paid out principal and interest. So we maintain a very healthy equity buffer over and above what our clients' deposits have enabled assets to be bought, because no manager is allowed to isolate any of their personal assets from the fund. This also really filters out people that are not serious, right? You want to raise capital this way, it is a very serious commitment of stewardship to your clients. It is like taking out a mortgage. You do not get to wriggle out of paying back principal and interest. You must know that you know how to handle the capital and beat an 8% return. Or we won't let you do it and you won't be allowed. Careful selection of managers, ensure that they have sufficient assets to do this, and then always monitor that buffer. Every person is expected to audit their assets every month. So I will publicly state what's in my portfolio, what it's worth, and how it exceeds client obligations every single month. Once a year, we get a third-party audit of that. So in short, check the manager's skill, check their assets, make sure that these are monitored monthly and reported publicly so that clients can see that too. There is no way a client can lose money unless they systematically watch their manager mess up everything, erode their net worth to zero, and at no point say, you know what, I think I'd like my account moved to a different manager. And of course, we manage our managers very carefully to make sure that never happens. It has never happened. As mentioned, as a professional investor, once your skills are set, it is not that difficult to beat 8% per annum. And so we make sure we keep people on staff that can do this consistently, with every reason to believe they will get better with time, not worse with time.
So the model isn't pretending risk doesn't exist. No. It's acknowledging risk and then structuring around it.
Precisely. You always have to have substantial equity buffers in this business to make sure you can afford to keep your clients safe.
Let's talk more about the education piece. You said the platform is meant to teach people how to become real investors, not just passive depositors. What does that journey look like?
That's right. So if you know nothing, we'll of course start you off as just at least get 8% on your money. If you know nothing about investing, start with there. But then the forum will show you deals, for example, like if you're an unaccredited investor and want a place to get started with, there's a great company called Energia. They will let you get started for as little as $100, and you can invest in solar panels, make a return as high as 14% per annum. They have a 3-year lockup, but it's not a terrible lockup. If you need to get out in less than 3 years, you take a 5% haircut. And they have a secondary market where, again, they're illiquid assets, 20, 25-year assets. You build them, you hold them for a very long time. But if you have a secondary market, when people wish to get into the fund and someone wants to get out, they're matched together. So they have an average redemption of 11 days. This is a great place for people to get exposed to a great operator, a wonderful product, solar panels, and a great return, 14%, with some options for liquidity in emergencies. So that would be a good starter deal. Another happy to call out is Mogul.club. This is where the pad splits I mentioned, single house, many tenants, or short-term rentals, which they also manage professionally, are available, and you can participate in one of their deals for as little as $250. Again, you don't need to be accredited. So if you were just starting out, having a portfolio of cash in a Stairway account, getting an index fund, choose your favorite one. I like DSI, it's the socially responsible index fund. Some solar panels and some real estate, Energia, Mogul. This is already a good start. And then you can build on that. If you are accredited, most of the deals that we post publicly have to be for accredited investors only. That's the regulatory framework that we have in the US. If we're talking about deals publicly, they have to be deals where you can only get in if you're accredited. But those deals can be built up to. Also, if you don't have the finances to be accredited, being accredited means at least $200,000 as an individual for 2 years, reasonable expectation of the same in the future, $300K as a couple, or at least $1 million in assets excluding your primary residence. For many, that's a very high bar to reach. You can become accredited in other ways. You can do your Series 65 exam. It's not as though that world is closed to you just because you have a career that does not lead to that kind of wealth. You can study for a few $100 and learn how to become an accredited investor, and we'll support people on that journey. So get started with the assets that are available to everyone, and then invest a small amount in your education. You get a qualification that allows you to participate in the more profitable, professionally managed deals. So this is the concrete plan that we take. Once you are accredited, then we'll show you deal after deal, quality operator, quality deal, that you can start to build out your portfolio. If that's where you choose to end the journey and just work towards your financial freedom over a long period of time, acquiring assets, so be it. If you wish to learn how to run your own managed fund and get there faster, we'll show you how that works too. We have templatized legals, a securities lawyer that can help you set all of that up so you can start to advertise, get your own clients. And again, we've taken people that full journey. The best student, if you like, has raised $12 million so far. We have people that have a managed fund with their full complement of 100 investors. So this definitely is an option for people that are ambitious and wish to push it further, and it's something we've a long track record of helping people do.
Where do you see Stairway going from here? What's the larger mission?
Next step is Regulation A. So I mentioned that, many wonderful investment opportunities you have to be accredited. It's quite a barrier to entry. Most people aren't accredited. So right now, me personally, I'm studying for my Series 65 securities exam, and the goal is to upgrade Stairway so that it's a Regulation A fund, which means anyone can participate. Anyone can open an account. That's the next goal for this year. Once that's done, we really open up the ecosystem to be more accessible more easily to even more people. That we also plan to templatize so anyone can be part of that fund and raise more money from ordinary people in a regulated manner that is compliant. The other aspect that we are working on in terms of next step is we now have a white label service. So if you have an existing business raising capital and deploying it, if you're already a professional investor, if you love the brand and the clients and the trust you've already built, but you raise equity as capital, you raise capital as equity, which is very expensive, right? Mm-hmm. And you wish to experiment with, learn how to raise capital as debt, which can be cheaper, then we can build a portal for those people that is 100% their brand. We just run the back end. So we make it as simple as if you know a client and you have a good relationship with them when it comes to equity and you'd love to offer them a liquid account, and you have, as many multifamily operators do, hundreds of millions of dollars or billions of dollars of assets on your books, that can be used to back deposits. Then you can use the platform we've built to talk to your client and say, hey, client, we have a great relationship, we've invested in all these deals. Would it be useful to you to have an account that pays 8% per annum and is fully liquid with no fees? It would? Great. Name and email, here is your account, and then our platform takes care of everything else. Gathering necessary details, processing transactions, monthly statements, annual statements, tax documents, everything. So we want to make it a really lightweight product that anyone can use. People everywhere deserve a better return on their savings than they currently get. And if you think about what a high yield savings account really is, even if you are getting 4% these days, with inflation around 2.5%, you're really getting about 1.5% in real return each year. And that return is taxable. So, you do the math. You don't get a lot. You get pretty close to nothing. You should get more. Not just that, with the bank, there is no transparency into how that is invested. You don't learn anything with money in a bank. Here you do. You get to see exactly how that return is built. And you can see that there are ways to grow your wealth far, far faster than having money in a savings account. All the way up to and including, if you wish to really accelerate things, learn how to run your managed fund. So we wish to have an impact on the banking sector, show people a different way of doing things that is more profitable, more educational, and we wish to have an impact on the capital raising ecosystem where great operators can afford to do better deals. And what does that mean? We're a big proponent of the idea that you should be able to do well by doing good, right? Do well by doing good. You can do well by doing bad, but why would you? If you can do well. If you can address a need in a market, build affordable housing, convert a hotel, these are really good things to do for the community. And at the same time get a great risk-adjusted reward. If you can invest in solar panels, right, and get a great risk-adjusted reward, why wouldn't you? Why would you stray to things that are detrimental to society and the planet just to get a return if you can do well by doing good? I would also argue that too many people set their sights on building wealth for luxury. The world doesn't need that. Look out your window, right? We don't need more people doing that. We do need more people that say, hey, I have opportunity, I have brains, I have talent. How about I use that to build wealth to do more good in the world? There's a great need out there. So spreading that attitude of growing so you can do more good is the ultimate goal of what the Stairway ecosystem is. We don't just teach you how to invest, we teach you how to invest ethically. We don't just teach you how to build wealth, we teach you how to build wealth for a purpose, for a reason that is not buying another luxury car. That is not a good purpose. That should not be what is on your dream board motivating you to do. You want a good reason to get wealthy? There are 9 million people that starve to death a year. 9 million, right? 1,000 people an hour. You want to work on something? How about work on that? Extreme poverty is the number one cause of human death and suffering on planet Earth. And my goal with Stairway is to take it everywhere, not just to the accredited investors, not just to the retail investors in the US, but everywhere. How about you teach someone who's really on the bottom of the economic period how to handle capital, how to invest at scale? That's the dream. How do I get all the way down to there and help people everywhere that are really living on the brink do better? Financial education and access to capital is what makes the wealthy so wealthy. How do I bring that to everyone is really the ultimate goal of the ecosystem.
I think that's a great note to end on, Austin. Thank you so much for joining us. This was a really thoughtful conversation, and I appreciate how clearly you broke it down. A model that many people find surprisingly and timely. Me personally, everything you've said, I've grabbed onto, and I'm going to take action myself. And as you know, I've spent 20 years running a hedge fund. So it's a different approach, but it sounds like the most sound approach I've heard of and paid attention to in a long time.
Thanks, Anthony.
Yeah. Thanks for everyone for listening. This has been Banking Without Banks, how Stairway invests and pays 8% with 7 days liquidity. If you enjoyed this episode, share it with someone who's rethinking how money, liquidity, and investing should work in the modern world. We'll see you next time. Bye-bye.